Hi, welcome to Challenge JP. My name is Jacek, and today I'm going to show you how to create a project finance model in Excel.
Okay, first of all, let's start with the structure of the model itself. So I'm going to start from showing you how to create a simple cash flow for a project finance model. I'll show you very quickly how to create a forecast of revenues, then costs, then other items such as capex, tax, and working capital to get us to a unlevered cash flow, so the cash flow before any debt injections. Then I will proceed to show how to create a debt model, or how to inject the debt model into our project. So that will be that part, and that will be one of the source of the financing of the model. The other one being equity and the revenues of the net cash flow being generated by the project. Then I will proceed to show you how to consolidate different projects, generic projects, into one cash flow view. So this is where I will get to the view over here. So you will see that I'm going to use some time delay different between the projects themselves, a bit of a scaling to consolidate different projects into one view. So you will see that cascading view of different component of cash flow, which will then allow us to do a forecast for consolidated cash flow for one big project or one big company. I will get into a detail into how to forecast on a monthly basis the revenues and costs, which I mentioned before, and also debt. And eventually this will get us to that consolidated view that I mentioned. And then this will give you an illustration of how you can, illustration of different sources of funding for your project. Let's start then from the monthly cash flow. So I'm assuming that for that project, for the project finance, for a project finance example, I'm going to assume that we're working with some sort of construction or infrastructure project. One of the things to keep in mind is that you do want to have a project that generates a steady, predictable level of revenues, because that revenues will be used to, will be our basis to forecast the debt. Okay, so you will see in here that I start my models from having the drivers on the top of the spreadsheet, and then having the inputs into the model listed on a monthly basis, and then the output of the calculation that follows that. Okay, so for example, again, let's assume that this is an infrastructure project. So, for example, it's a telecom project where you connect different buildings, or a number of buildings, number of homes to your network. So that's where you see I have the incremental units. So, for example, we would assume that on a monthly basis, you will connect 150 units, being, for example, homes or buildings, to your network. Okay, which will then give you a cumulative number of units. Then I have a revenue section. So there are two inputs for the revenue sections that I'm using. So it will be the upfront fee and then the monthly fee. Upfront fee is, for example, an installation fee. So again, if you think about connecting, I don't know, telecom equipment, for example, internet to your home, you may have a provider who charges an installation fee, an upfront fee. So this is just a one-off, and then there will be a monthly fee, which is a recurring fee done in periodically, in our case, on a monthly basis. Okay, I've also included the RPI index in here, so you see that allows you to set inflation or increase in prices on an annual basis, and you see that at the moment in the month 1 it's set to 1, but then when you get to a month 13, so you past 1 year, again, everything's done here on a monthly basis, that index increases, right? And then you will see that the prices here that I'm using, the average prices, are also increasing along with that index. Okay, and then going to the monthly revenue calculations, I'm simply taking the number of, for example, to calculate my upfront fees, I take the number of incremental units connected, and then I multiply it by $75, which is my upfront fee. So this is that installation fee that I mentioned before. And for my recurring revenues, I'm using the number of cumulative units. So again, I'm summing up all the units that I've connected. So those are all the units that are connected to the network itself. And then I multiply it by my monthly fee coming from those customers. Okay, so in this case, it's $37.5. So 600 times $37.5 gives me $22,000 in revenues. Okay, and that in total will give me my monthly revenues. Okay, so those are the revenues that I'm forecasting for that particular project. Okay, then I want to proceed to direct cost assumptions. For example, in our case, what I did, I use a simplistic assumptions here. Again, when you create a model, you do want to create, you want to introduce some simplicity into the model. So in this case, I'm calculating my marketing, for example, spend as the function of the number of new homes connected times my cost per acquisition. Okay, so my cost per acquisition here is, for example, $60. So what I'm saying is that if I'm assuming that I'm going to connect 150 or I'm going to add 150 customers to my business, then in order for me to calculate the marketing cost I'm going to spend to acquire those customers, I'm just going to multiply those number of customers times the average cost per acquisition. In our case, would be 60. Okay, so this is one of the example of direct cost. Again, this cost is a variable. So for example, if I have less customers and if I keep that 60 as fixed number, if I halve number of new customers, my revenues will decrease, but also the this direct cost. Okay, so again, this is cost that's directly correlated with your revenues or the number of new customers that you're adding at the moment. And then also I've added other costs. So in this case, I'm just assuming I'm using here a very simple assumption that you will take a percentage of revenues as the basis of the calculation of that cost. So for example, I'm saying that for the other cost, take the monthly revenues and then multiply by 5%. Now you can think of monthly cost as anything from, for example, processing fees. So for example, if you processing payments, you probably will have to pay a percentage of that, of your income or of your revenues that you receive to payment processing party, for example, your credit card billing provider, as well as you may calculate, for example, that there's a percentage of your revenues that you have to spend for customer service maintenance and so on and so forth. Okay. Now that combination of, so if I take the my revenues and then I subtract from this revenues, I subtract my direct costs, this will give my gross margin. Okay, so this is the first part of the of my cash flow model. And then let's proceed to salaries and general Opex. So the way I model or forecast my salaries here is by dividing the headcount into two types of roles. Okay, one is called here central office headcount. So I'm just assuming that basically, in order to run the company, you need to have a level of central office management headcount. Okay, and that number will be more or less static. Okay, so in our case, it's 5. So that's the first sort of basic layer of your headcount. And then in the second part here, what I'm saying is that you will increase the number of, you will have that incremental headcount, which will increase along with the number of customers that you have. So basically what I'm saying here is that for every 500, for every new 500 customers that you put, that you have in your business, that you sold your services to, you have to add 1 headcount. Yeah, so you'll see that in here, and this is just rounding up. So basically, I'm starting adding new customers. So I need to add 1 more incremental headcount. I'm having 450 new customers here, and then I'm having 600 customers. So I cross that 500 threshold that I set in the model, and then you just adding another headcount. Okay, so basically a very simple. Again, that's related to the number of customers that, or number of homes that you have connected to your network. In our case, in total. And that will determine the level of headcount that you need, that incremental level of headcount. Okay, this could be, you can call it operational headcount or customer service headcount, however you want to call it. And then based on that, based on those numbers, I simply take the number of my central office headcount and then multiply it by the central office salaries to get to the total salaries. And I do exactly the same thing with incremental office salaries. Okay. On top of that, I'm also adding some bonuses, and then just scrolling down here, I'm also calculating the office cost, which will be driven by the number of headcount or number of employees that you have in your that you've hired, and then I'm also assuming some other Opex, also some fixed admin cost, a bit of a contingency. When you calculate the salaries, you may want to consider either using the average salary as a fully loaded salary, so that would include all the taxes, any pension payments, and any additional payments that any additional costs that are related to your employees, or you may actually separate them, but then remember that you have to include them in the model somewhere, okay? And you will just connect them to the number of employees that you have, right? So those figures, so the salaries and the general Opex will give you my salaries and general Opex number, and this number will then allow me to calculate EBITDA. EBITDA is the earnings before interest, tax, depreciation, amortization, which in our case here is just the gross margin, so the revenues minus direct cost, and then minus the salaries and general Opex. Okay, and then last but not least, I've also included the CapEx calculation. Those costs may be quite substantial. So for example, in this case, I'm assuming that every customer that you're adding to your business costs you $750. So that's therefore that CapEx number that you see in here. Okay, so that will give you your CapEx. Then I'm also using some calculations for the tax. So it's important that once you start generating you start generating profit, you do want to assume that you will pay some taxes. And then I've also included some working capital movement, which is just the difference between your payable and receivable movements, which then this allows me to calculate my unlevered cash flow. Cash flow being my EBITDA minus the CapEx minus the tax, and then adjustment for the working capital. I call it unlevered cash flow, which indicates that this is the cash that comes before any debt injections. And that is something that I want to talk about next. Okay, so let's now look at how I've calculated the debt. Now, there are probably a few different methods of using of adding debt to your plan. But what I did here, I created a relatively simple model for the debt calculation, which assumes that you have a number of draws, so the number of times when you draw the debt in your model. Then the model has a term. So in our case, for example, I set it for 12 years, but again, you can set to whatever assumption you think is appropriate. There was a maximum debt, so there was a debt ceiling that I set, which I will get back to in 2 seconds. And then there was, obviously, as with every debt, there was an interest associated with paying the debt. Now, the basis of the model is EBITDA. So we're assuming that, so the model is assuming that there's a maximum level of debt that you can draw at any given time, which is based on the EBITDA, so that earnings before interest, tax and depreciation figure that you generated in the previous year. So for example, let's look at the calculations here. So we see that the model you generated 225,000 EBITDA in the previous year. We set the model where your maximum debt can be 5 times that EBITDA. So at any given time in your model, the maximum level of debt that you can draw is 1.1 million dollars in our case. And the model draws the debt at the beginning of every year. So in this case, this is month 25. So that would be a January. So what the spreadsheet does is it just looks at that debt ceiling, which is 1.1 million. Then it looks at, okay, well, how much debt have I drawn so far? It's 0 in this case. So it's basically saying, okay, well, I can draw the full amount in here. Okay. Then the remainder is a calculation of the principal repayment and the interest. Okay. So let me show you very quickly the calculation of total repayment, which will drive those two figures, so the interest and the principal. Now, I'm using the formula here called PMT formulas. This is an Excel formula which calculates the payment, the amount of payment that you need to make in order to repay a certain level of debt over a set period of time, assuming an interest rate of X. Okay, so if you very quickly click on the PMT formula here, I just bring it to the left. Okay, so you start with the rate being the assumption here, so 12% divided by 12. The reason why it's divided by 12 is because you want to that is quoted on the annual basis, and you want to convert it to a monthly basis. Okay, because the model is done on a monthly basis, so you take the 12% divided by 12. Then the NPER is the number of periods over which you want to repay this debt. So in this case, you see there's a counter here. Remember that we set the debt facility to be a 12 years. So you'll see that, which is 144 months, and you'll see that 144 months figure is decreasing over time as we're progressing with our model timeline. So that is the number of periods over which you want to repay the debt. And then the PV, which is just the amount of debt that you want to, the amount of debt that you use to as the basis for the PMT calculation. The debt is simply your opening debt balance plus any debt that you have drawn in a given month. Okay, so that gives you the your payment calculation. So that's your total repayment. Now we also know that the interest. The interest calculation is quite simple. You simply take the your opening balance plus any debt drawn, and then you multiply it by the interest rate, again divided by 12, because that interest rate is annual, so you want to make it into a monthly interest rate, and that calculates the interest that you have to pay on your debt, and then anything that any reminder of that figure. So anything that's left after you pay your interest, you deduct it from that repayment calculation, and that will be allocated to your principal repayment. So to repay your debt amount. Okay. And then if you scroll to the right, you will see that that calculation then is repeated over time. And then you will see here we have a second period of it when we draw the debt. Now you'll see that, okay, here I've generated in the previous year, I've generated 554,000 in revenues using our 5 times EBITDA multiplier to calculate the maximum debt. I know that I can draw 2.77 million in total. I have already drawn 1.08 million, which means that I can top up my debt by another 1.69 million to get to that 2.7 million figure. Okay, again, your opening balance and debt drawn cannot exceed that level, the maximum level of debt that you can draw based on your EBITDA. Now, with this calculation, we can scroll back to our cash flow model here, and you see all I did here is just link the outcome, the output of the debt calculation below. So you can see that, okay, well, I can now add to my unlevered cash flow the debt draw, the debt repayment, and the interest paid. Okay, so that gives me my net debt financing. And then if I add, you take that figure here, for example, so I can say, okay, well, if I take my unlevered cash flows and then I add the net debt financing to that, that's the number, that's the levered cash flow that I will receive. Okay, and now going back to my project summary, you can see that all I did here is I just summarized those figures. So I'm using exactly the same structure, similar labels to summarize the debt, and then you see that I should get to exactly the same cumulative of yearly unlevered cash flow figures and levered cash flow figures as in my monthly view. Now let's look at how we can combine multiple projects into one consolidated view. So let's go to that consolidated summary sheet, where you can see that I have different projects. Yep. All I did in here, I took that one generic projects that we just created, and I applied timing between those projects so that I spread them across the timeline. And then I also added an ability where you can scale some of the projects in here. So for example, you can assume that you can create one generic project, one single project, and then you can use that project to multiply it across a different timeline, and you can also apply some scaling. So you may say that, okay, well, this is sort of a project, a standard project, but maybe I'm going to add 5 projects like that or 4 projects like that, but 1 or 2 of them will be of a different scale, right? So there will be a smaller compared to that original view. And you can use, this is where you can use the assumption here. So for example, you can say, okay, this is my project. This project and project 4, project 5 will be built on a different scale. So it will be half at the size of my standard project. And then you can also create some assumption here where you say that, okay, I want to add each project every 9 months. Okay, so that will take you to this view where you see that the upfront revenues, recurring revenues, and all the major components of the cash flows will be laid in that format, and this will eventually take you to your unlevered cash flows and the levered cash flow. Now, in order to stack those projects like that, all I did, I've used the spreadsheet here called Consolidated Cash Flow. Again, this is the cash flow, this is the forecast done on a monthly basis. And you will see here that I've just listed, used the similar labels to the labels that I use in the project cash flow, my single project cash flow forecast. And then I would offset the project's starting date depending on that start month date that I have in here. Okay, so I'm assuming that my first project will start in month 1, then the second project will start in month 10, then 19, 28, 37. Those numbers here, they come from the assumption that I use in here. So here I assume that you want to spread every project by 9 months, for instance, right? And then you will see that if your starting date is, for example, January 23rd, that means for your first project, that means that second project will start on October 23rd, 24th, 25th, 26th. And here, as I mentioned before, you can set, you can scale the project if you want to, for example, make some of the projects smaller. Okay, the assumptions here, those assumptions feed into the project cash flow sheet, which we look at just now. So those are those assumptions here. Those are those numbers. And then there's some additional assumptions around the debt calculations and also valuation, which also feed into our calculations, monthly calculations. Okay, so if we get back to the consolidated cash flow, let's see. So incremental units, remember we had incremental units at 150 per month. So you see, so that's exactly, the first project will repeat exactly the same cash flow profile as we had in our project cash flow here. And then the next project, you see, it repeats exactly the same numbers, but there are 9 months later, okay? And then again, the same thing will happen for the project number 3, which again happens 9 months after the previous project. And then for project number 4, you'll see, because we're using the scaling of 75, those numbers will just be half. Okay. In terms of that calculation is then repeated all across other outputs. So, for example, cumulative units. Remember the upfront revenues. Again, they will just repeat themselves. Again, except for the project number 4 and 5, where we're using the 50% of scale. The same thing for the recurring revenues, other revenues, gross margin, and so on and so forth, and eventually all the way down to the unlevered cash flow, and then the levered cash flows, which include the debt calculation. In order to introduce this delay between different projects, I've used the index formula. So the index formula, we double click on here, you see that first of all, the formula looks up into the month number, so the timeline for the consolidated project itself for the cash flow, and then as soon as the my start month is equals or is greater than the month number on the timeline, then it uses the index formula in order to link appropriate numbers. So using the index formula allows the model to take the number from a month that is relative to the month number here, and also to the start month. Okay, so in this case, for example, we know that the overall month is month number 13 on the timeline here. My starting month for this project is 10. So what we're saying here in the formula here, we're saying that, okay, we'll go to the project cash flow at G8 and DV8. The 8 will be the raw number from that project cash flow sheet here, where it stores all the incremental units. And then it says, when it says row 0, it's just basically saying that, okay, we'll stay on the same row. And then take the number 13, which is the number here, then minus the D12, which is, you can't see it here, which is the number here. So it's 10. So take the column 3, so 13 minus 10, plus 1. So it's basically going to say, okay, in this case, linked the number from the column 4 in the row number 8, and then that's the number that you're going to use. That's the number that you need to insert in this model. Okay, so it's using that index formula, which is working quite nicely here in order to offset the numbers, in order to put the right number in the right month, and then finally just multiplies all the numbers that you get from that project cash flow sheet by the scale assumption here. So in this case, it's 100%, so it doesn't have to actually scale it up or down. But for example, in project 4, again, it would use, if it wasn't scale up to 50%, it would use the number 150. So that would be the 4th month of the project. Remember, there's a 3-month of break between we start connecting new customers, and then it just multiplies that number by 50%, which is that scaling that we apply. Okay, finally, that leads us back to our consolidated summary. So you see that I've consolidated all of the numbers here for a particular year. Here I use the SUMIF formula. So I'm basically saying, okay, looking at the revenues, let's sum all the numbers that are related to 2025, 2025 being the year in the row number 7 in here. So that consolidates all my revenue numbers here, and again, all the costs, salaries, Opex, things that we've covered, and that will give me my unlevered cash flow. So unlevered cash flows for singular projects, so for those individual projects, which then will just sum up into one unlevered cash flow for overall project. Same thing with the debt financing, and that overall will give me the number, my cash requirement for the whole project, so for the consolidated project, and that allows me to do a simple valuation, so return calculation in here, where using the EBITDA again as my basis for calculations. I'm assuming that there was an EBITDA multiplier in order to calculate the exit of proceeds that you will get after 10 years. So for example, if you were to sell the company on IPO debt, I need to adjust that number for any outstanding debt balance, assuming that you have to repay that debt when you exit, or you have to take it in adjust that exit figure for your in your valuation. And then if you have any assets, you also have to include that into calculation. This allows you to calculate the cash flows, which then are basis for your IRR calculation, so internal rate of return, and also your NPV. And then I just bring those figures here. So you see all those are all my main assumptions. And then I have my metrics in here. So your equity requirement, assuming that any gap between your any gap that hasn't in your cash requirement that hasn't been covered by debt, and the revenues or net cash flow coming from other projects has to be met by equity. Now, having that assumption page in here allows you to very quickly do a bit of a sensitivity analysis. So for example, if you only look at the IRR itself, you can see, okay, well, what would happen if I were to change my interest rate from, for example, 12% to, for instance, 8%? Yeah, how is that going to influence my, for example, equity requirement and my IRR? You can do exactly the same thing with other inputs. For example, your revenues. Okay, what if my revenues was instead of $37 per customer, what if it was 45? So you can see how that influences your IRR. You see that's quite a sensitive figure. So that playing with those assumptions here and looking at the main outputs, main metrics, allows you then to stress test the model and see what's the most sensitive part of the model. Okay, and then last but not least, I've also added the template has a bit of a graph, so that allows you to show, okay, on the cumulative basis, the sources of your financing. So I mentioned before that the model assumes 3 sources of financing, project financing in here. So there will be debt, which is the part over here. Again, this is a cumulative structure. Then the equity, so anything that comes from, for example, your investors, and then also project revenues. So the revenues, so that consolidated view assumes that you can use some of the revenues from the earlier projects. You can use that also as a sort of source of financing. So that's the cumulative structure, and then you can see it how that changes on the incremental basis. For example, in here, the model assumes that, okay, well, at the very beginning, so in your first year, most of your funding will come from equity. Then you start generating some revenues from your projects. So that will also provide some funding. And then as your company is maturing, so remember, you start generating this positive EBITDA, you can then start adding some debt. This one also assumes that you may actually start repaying some of the equity. Okay, so that again, that's just a simple simulation or illustration of your project financing and the source of your overall funding.
I hope you enjoyed this tutorial. If you have any questions, if you'd like to download the template using the video, follow the link which you will find in the description, or visit my website at www.challengejp.com. Thank you very much.